My last guest this week, certainly not least, is Bill Davis, founder of STNC Capital, who specializes in quantitative ESG asset management and research. And earlier this year, they launched their first ETF. It's the STNC Equity ESG Large Cap Core ETF, ticker STNC. Bill is now on the line with me from Boston. Bill, it's a pleasure. Welcome to the podcast.
Hey, Nate. Thanks for having me.
Okay, so the strategy being offered in STNC, this was actually first offered via separately managed accounts, SMAs, and you made the decision to put this into an ETF wrapper. Now, we're going to cover a lot as it pertains to the ETF itself and certainly ESG investing overall, but I'd love to have you start by talking about that decision. Why decide to go the ETF route?
Yeah, sure. So actually, we had been available as a separate account in SMA and also through model delivery, actually going back on the SMA side, going back to 2014, so close to an 8-year track record. And we are very active, and for taxable clients, it made a lot more sense to consider a structure other than an SMA simply because of the inherent tax advantages within the ETF structure. And so I'd say that was one of the reasons, just better tax management for taxable clients. I'd say the second reason is that the SMA or the underlying strategy of STNC ESG Large Cap Core is semi-concentrated, typically holding about 50 positions. And as a result of that, we ended up with a composite minimum of $150,000 within the separate account. And so, the second advantage of an ETF, of course, is that we could really democratize access to the ETF for, say, smaller investors who, might want to invest $25,000 or $85,000 or some other number, lower than $150,000. And then I would say sort of less important, but there is a third reason, and that is that most of our assets actually come through other financial advisors, whether they be broker-dealers or banks or RIAs. And frankly, I think buying a ticker symbol is in many ways the preferred, approach to investing in any strategy. And so that's not really an argument for an ETF versus, say, a mutual fund, but getting to a ticker symbol was important to us, and the ETF just made so much more sense from a tax standpoint than a mutual fund.
Okay, so explain the strategy itself. You mentioned it's semi-concentrated. Obviously, this is actively managed. You're seeking companies with strong ESG indicators. What does the investment process look like, and what does this ETF end up holding?
Right. So we, first of all, we invest in members of the S&P 500. So we're in the largest, most liquid segment of the economy. Secondly, we seek to invest at the intersection of what I would describe as strong underlying fundamentals and relative to industry group peers, attention to environmental, social, governance, off-balance sheet risks and opportunities. And so there's kind of a lot to unpack there, but one way to think about it is there are 3 parts to portfolio construction for us. The first part is an ESG process that is entirely rules-based, and I should say that we're systematic in pretty much everything we do, but when you're talking about ESG, it's hard to describe it as purely quantitative, so I would say in our case the ESG component is rules-based. We basically have developed 24 material risk factors, which we refer to as, key performance indicators or KPIs, that could apply to any company in the universe, but are essentially applied by industry group. And so an industry group like, automotive parts might have, 18 of the 24 KPIs apply to it, and whereas banks might only be 8. So essentially, within each industry group, we are quantitatively ranking and scoring companies against industry group peers on the KPIs that are relevant to that group, and then we're impact weighting them. And in doing all of that, we end up essentially eliminating half of the S&P 500, which is sort of obvious because we're keeping the top half of every group and getting rid of the bottom half. But before we do the final scoring, we also crowdsource data from trusted, mostly NGOs, but not always. In fact, Norges Bank, we get data feeds through Norges Bank around human rights violations and environmental risks. But generally speaking, it's NGOs looking at issues like farm animal welfare and illegal logging and palm oil deforestation. And if a company that's in our target universe is also kind of identified as a laggard by one of these trusted resources, then they essentially get a point deduction. And so this ESG component of portfolio construction gives us both sort of a traditional view of what companies are saying about themselves and where the momentum is, plus we then get more of a kind of a front windshield update from NGOs, and it enables us to essentially eliminate what we think are companies that represent ESG risk. We set those names aside. Let's just say it's a couple hundred companies after all that work. The second part of the process involves a machine learning approach that looks at over 20 years of company-specific filing data, historical market data, looks at the current market conditions, does so through a lens of about 50 or so fundamental financial and risk factors, and attempts to predict which factors are most correlated with total return and alpha for a 3-month look forward. And so that process essentially retains the 50% of the S&P 500. So now we've got two piles of companies. We push the piles together. Think of a Venn diagram. The overlapping securities become candidates for the portfolio, but we now have a problem, which is how to weight these securities. And we actually have a risk optimization process that we built internally, which, unlike traditional optimizers, isn't really focused on stuff like tracking error, but rather we are really just trying to mitigate tail risk and create as much diversification within the portfolio as possible. And the sort of the intersection of those three processes yields what could be on the low side 35 names. On the high side, it could be 75 or so, but typically it's right around 50 names, and we go through that process every single quarter.
Bill, in your description there, you mentioned data feeds and obtaining data from trusted resources. And I know ESG data is getting significantly better, but from my perspective, it still seems like a pretty big challenge in this space where, depending upon who's providing and evaluating the data, ESG ratings can be all over the board. I've seen numerous examples where you'll have one ESG ratings provider that will have a company very highly scored in a particular category, and then you'll see another that has that same company rated very poorly. I'd love to have you just talk a little bit about that challenge and how you're attempting to tackle it.
Nate, really good point. What I would say about data, and it's funny because I go to a lot of industry conferences, as do you, and generally speaking, ESG is kind of on everybody's mind, and right behind it is the poor quality of ESG data. And so I think, I guess a couple points. One is the world can't really wait for the data to be perfect, and I will tell you that the data gets better all the time. I have a little bit of a perspective that comes through engaging with companies, and specifically I'm involved in engaging with a member of the S&P 500 that is a target of something called Climate Action 100 Plus, which means that if we were going to decarbonize our economies around the world, there's really about 150 companies that we can't do it without. That's one way to think about that particular process. And the thing that I've learned through that process is that this is very much happening. Companies are being, sometimes willingly, but frequently unwillingly, are basically being forced to be more transparent around some of these off-balance sheet risks. And because of that, but there's this huge lag, right? Because a company might file its annual corporate sustainability report in the month of May, right before their AGM, which is in June. And the reality is that data is based on the previous year or a couple of years worth of behavior. So here we are at the end of 2021. We're looking at data actually, which is generally speaking from 2020 and 2019. That's what ESG product people have to work with. And so I think the single biggest problem is just kind of the latency of the data, coupled with the fact that I think companies have ways of optimizing how they present the data, and in some cases just leaving it out entirely. But it is getting better all the time, and I also think that increasingly with advances in AI and big data, there's just really kind of fewer places to hide.
To your last point there, I find that really interesting. I mean, how do you handle companies who either don't report ESG data or perhaps it's questionable ESG data? I mean, is the assumption that they're hiding something and so they get negative scores? How do you handle that?
Yeah, so this gets kind of hard, right? So we have adopted an approach at Stance where we try and be as unemotional as possible. And I'll give you a really good example. You may remember kind of maybe in Q1 of this year, there was the Barron's piece about the 50 companies in the S&P 500 that essentially pay no taxes, right? And I saw that piece and I, keenly looked up the list thinking, boy, I hope none of them are in my portfolio. And it turned out probably 13 of the 50 were in the portfolio. I might be exaggerating. Maybe it was 8 or 9. But the point is, I was thinking, well, that's not a very good look from an ESG standpoint. But the reality is, one of the things that we try and do as managers is think about issues like that within the context of other things. So you never want to overreact to finding out that a company you own doesn't pay taxes if you've determined that paying taxes is not good. However, what about the other things that they might be doing well? What about the fact that maybe they are in the process of dramatically transitioning their revenues from being carbon intensive to carbon light? Or the fact that they are doing a lot as it relates to diversity and inclusion or anything else, right? So the point is that we have 24 key performance indicators because there's 24 things, number one, that we need to look at. Number two, we've got to assign a relative weight to each of these things. And it turns out that, paying taxes is about 2.5% of the score that we give a typical company. So I think the issue of data and the sort of the ground truth having to do with that data is always going to be an issue. I think the biggest single issue is just the fact that the data is old. It's less so that I think companies are, trying to misguide investors. I mean, that does happen certainly, but I think that the biggest issue is that it's old, and I do think that just technology is going to solve that because we're not going to be necessarily waiting for a big industrial company, to submit their next CSR filing. We're going to actually be able to pull updates out of news releases, out of press releases, out of other documents that we can obtain with or without their, involvement or consent.
Bill, as we mentioned, you are taking an active approach here. And so I have to ask you the question I ask just about every active manager who comes on this podcast, which is that if you look at the data, the bottom line is it's tough for active managers to consistently outperform the market. And so the question I have for you is, why should an investor consider STNC versus an index-based approach? Does it come down to your ESG approach here?
I'd say, Nate, there's two questions in there. One is why invest in Stance versus another active manager. Another question is, active versus index. On the active versus index front, let me say that I think that ESG is an obvious place for active management for reasons that I actually just described, right? There's issues with ESG data that active managers can work around. They don't need to rely purely on CSR data or feeds from, Bloomberg or Sustainalytics. They can do their own research. They can augment it, and that's stuff that you're not going to get in a passive fund. So that's point number one. Point number two on passive versus active is it's really interesting. Like, I I need to describe what I do as a semi-concentrated portfolio, but shouldn't the S&P 500 also? I mean, you now have, and you probably know this better than I do, but I think you've got the top 7 or 8 names in the S&P 500 that account for 25% of the index, right? So I think that one of the, and furthermore, they are mostly very sector sort of biased or specific. So you've got, mega cap tech and comm services with maybe one exception that represent the top 8 names within the S&P 500 and, nearly 25% of the index. And so I think one of the values of active management is being able to actively manage risk. And so one of the ways in which we do that is to avoid being top-heavy or overloaded, in a handful of names and specifically in, 1 or 2 segments of the economy. So I think that's a big piece of it. I think with respect to why STNC versus another active manager, I mean, a piece of it is sort of in what I just said, in that I think a lot of ESG is growth-oriented, and there's nothing wrong with that, right? In fact, where would you rather be probably for the last 7 or 8 years? But not every investor is comfortable being a growth investor in any market, and certainly there's investors who aren't comfortable being overweight growth in this current market. And so I think one of the things that Stance does that is very unique is that we are truly a core manager. And in fact, sometimes, Morningstar's given us 5 stars that have been actually, and they've tilted us, into the value camp. And so the real point is that we at STNC, it's a core strategy versus a growth strategy. We think that it's a great natural complement to either an ESG growth strategy or something else. And then, I think the kind of the related point in there is that if you only invest in big tech companies that don't have a carbon problem to begin with, and your motivation as an ESG investor is to manage climate risk, you're not really doing anything to solve that problem. And so we view that there is a role for a manager like us who is investing across as much of the economy as possible, obviously avoiding things like thermal coal and weapons and tobacco. But generally speaking, we're not afraid to invest in industrials or materials companies because these industries are not going away. It's just that there's going to be winners and losers. And we think that the ESG framework gives us unique insight into who those winners and losers are actually going to be. And so we can position our clients appropriately.
Just about a minute left here. I did want to note that you're using one of the quote-unquote semi-transparent structures. It's the Blue Tractor Shielded Alpha approach, which interestingly, that's actually pretty transparent, right? Because investors can see all of the holdings every single day. They're just at different weights. But can you talk a little bit about why you wanted to use that structure?
Yes. So first of all, we did want to protect our own intellectual property, and the idea of actually publishing holdings and weights on a daily basis didn't have a ton of appeal to us. Blue Tractor, so the interesting thing for an ESG investor, you do want to know what you own. You just said this, Nate. So I think that as we looked at the various semi-transparent wrappers available to us, all of the other ones actually disguised what you owned, and that's the one thing an ESG investor cares about. They don't necessarily care about, do I own, 2.5% of Humana or 2.9%. What they care about is, do I own Humana or do I own, a tobacco company? And so the Blue Tractor approach to semi-transparency, I think, is tailor-made for the ESG industry.
Well, Bill, excellent discussion today. We did not have time to get to the debate portion of the conversation. I think most people know I'm a little bit of an ESG skeptic, so we'll definitely have to have you back on to go through some of my favorite rebuttals. But really excellent spotlight today. Congratulations on the ETF. Thank you for joining me.
Thanks, and I'll come back and debate you on that anytime.
Perfect. That was Bill Davis, founder of Stance Capital.